Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. If this is your first time, welcome. If you are a regular listener, also welcome back. As you know, our job is to make sure that we are crafting portfolios that can deliver positive returns in up, down, and sideways market. Yes, we are a fiduciary. The problem is 99% of everybody on the radio, advisors that you meet with, seminars that you go to, we all sound very, very similar. And it's hard to differentiate the top from all others when the markets do nothing but go vertical. Our offering is obviously unique. You know you have a good portfolio when you can look at something inside of your portfolio that can deliver positive returns even in negative markets. If you don't have that, if you want to reduce your taxable income by up to $90,000 per $100,000 invested, if you don't have a financial plan that can give you a high level of probability of success, written income plan, those are the things that we want to focus on. So you can give Paige a call, 630-492-1912, 630-492-1912. And set that time up to have a conversation. Come into the office. We are located in Naperville, just outside of Chicago. We do run the show in multiple markets. So if you're hearing our voice, then we can work with you. 630-492-1912. Generally, the first meeting is either in person or a Zoom or a conference call. It's really just to learn about what you're doing, why you're doing it, how you're doing it, what do you feel you're not getting, what are your biggest concerns. And then what we've been doing a lot recently is running portfolio stress tests, because when we can take the sales pitch out of anything and we can just look at raw data, I think it becomes very evident if you have deficiencies inside of your portfolio. That report is complimentary. I probably could pay, $2,500 to $5,000, depending upon how intricate your portfolio is. But the portfolio stress test is something that we find, if nothing else, you're going to walk away after you talk with us knowing how well your portfolio will do in various market corrections and historically, as well as up markets. So give Paige a call, 630-492-1912. Set up that initial call, and we will certainly share with you what we're doing, and most importantly, learn about what you're doing. Radio shows are unique, especially when it comes to finance radio shows. I listen to the bulk of radio shows, not only here in Chicago, but I pick a couple other markets to listen to some of the shows as well. And predominantly, they are sales pitches wrapped up in education. And generally on the radio, it is annuity sales pitches, but you don't know that it's an annuity sales pitch until you reach out to the advisor, and then every answer is going to end with, well, here's an annuity. And the challenge with these annuities, and we talk a lot about, the annuities, and we talk a lot about the lifetime income annuities, and if we look at inflation, $1 million today, back in 1995, that is equivalent to $500,000 today. Think about that. Mid-90s, $1 million. Today, that is equivalent to $500,000. And that is the effect of inflation. And when people are buying these lifetime income annuities, what you have to realize, please realize, is that income is fixed. It'll never go up. 1 out of 1,000 is my belief that you could see an increase, even if they say that it could. It's just they're not designed that way. So if you're buying these income annuities, you have to understand that what is inflation going to do to that income stream. Those are the things that we want to talk about. And if there wasn't other options available, then you take the good with the bad and you deal with it. But there are. And those are the things that I want to talk a lot about. Why do I talk about that? Is because the amount of money that goes into a guaranteed lifetime income annuity is staggering. And it's people just don't know what they are, and they don't know the downside of them. They don't know that your growth is limited on the upside, and they meter how much you can take out, and they know that account is never going to go to zero, because then the insurance companies would have to, start paying for it. And they don't talk about the effects of inflation over 5 to 10 to 15 to 20 years on what that income stream is going to do, or the effects of inflation on the income stream. So we're not against annuities in any way, shape, or form. As many of you know, one of our most liked strategies currently are the structured notes. We're currently still pricing, 12%-ish with 30% downside protection. Banks that offer them are, the big banks, JP Morgan, Bank of America, Citigroup, Morgan Stanley, UBS, Goldman, etc. So many people call in for those banknotes, and I absolutely, positively love it, because double digits with 30% downside is a really strong story to at least learn more about. And that kind of fills into our protected income bucket. And the other bucket that we use is a 5-year annuity. So on one hand, I say I just disdain income annuities, and on the other hand, I say, well, we've got a 5-year annuity. So what gives, Rob? And, well, the reality is the 5-year bucket, the 5-year annuity, it's a growth annuity, pure and simple. It's really a structured note, in our opinion, my belief, that, wrapped up by an insurance company. And so it has that annuity wrapper, but it's very, very simple. There is no income component. It is simply growth. And currently you get the first 9.5% of the S&P 500. Zero fees, the first 9.5% of the S&P 500, zero downside on an annual basis. And once you get a gain, that gain's locked in. So for protected growth bucket, man, that's a really strong story. So again, our job is to, as advisors, as educators, is to make sure that you know the good, the pros, the cons, the bad of every single strategy, and that we can craft portfolios that can deliver positive returns for some money, some allocations in down markets. Because here's what we're facing. Goldman Sachs came out last week, and they could be wrong. Who knows? I mean, what is the disclaimer? Past performance is not indicative of future results. I mean, that's for everything. That's for everything I say. That's for everything that everybody says when it's, performance related. We just don't know. And so you have to make sure that you are, looking at the research and try to identify who is delivering the research, and you have to look at their track record. But Goldman came out and they said they expect over the next 10 years for the returns of the S&P 500 to average 3% a year. 3% a year. Think about that. 3% a year. So Goldman is coming out and saying that based on the forward-looking markets, which obviously nobody knows, but at this current valuation, they anticipate a 3% growth rate over the next 10 years. I mean, don't shoot the messenger, right? Now that's one bank, and people tend to gravitate to whatever, your personal belief is. So you want that reinforcement. You want that anchoring. You want that if you think the market's going to go up, you're going to pay attention to research that and expectations and forecasts that support your thesis, your bias. That's just human nature. And so we have to make sure that if the markets do only grow at 3% a year over the next 10 years, what does that mean for your portfolio? We're meeting a lot with individuals that are 3 to 5 years from retirement. And so generally those that reach out to us, historically, it's been within 10 years of retirement or in retirement. And, people who have, what we consider to be significant means. And we meet with a lot of individuals that have portfolios in the, the $5 to $10 million range. And that's not a requirement to work with us by any stretch of the imagination. As you know, if you've listened to the show over time, we help investors of all sizes, 100,000, 500,000. It doesn't matter. It does not matter. We're here to help. We think everybody needs help. But recently, for whatever reason, we've been meeting a lot with individuals in the $5 to $10 million range. And generally, those individuals have been do-it-yourselfers, business owners or high-wage earners that have just managed the money on their own. And they are recognizing, and I give them a ton of credit, that they are recognizing that the next 3 to 5 to 7 years has the potential to be significantly different than the last 3 to 5 to 7 to 10 years, and probably not in a good way. You look at inflation. Inflation is high. They cut interest rates, yet the 10-year is spiking. What does that mean? Well, that means that Wall Street thinks that inflation is not what they say it is. They think that, the bond market, could continue to spike. And if that does happen, goodness, watch out below, because the markets could see a significant correction. And most investors are simply not prepared for those corrections. And that's one of the beauties of the portfolio stress test is, like I mentioned earlier, most financial advisors like myself can sound very convincing, can sound very educated, can articulate compelling stories. But I know most people have absolutely no protection inside of their portfolio other than an up market. And so when you lose money, when you go through, early 2000s, when you go through a 2008, a 2018, a 2022, and you reach out to your advisor, the story is, well, just sit and wait. It's ultimately going to come back. Well, nobody is debating whether the markets over the long term go up. That's not up for debate. Nobody is debating that. But I want to hear what your advisor or yourself, if you're managing the money, what are your thought processes on if you had bought Microsoft in 2000, it took you 14 years to get back to even. So for those that don't think the markets can stay sideways for a long period of time or actually go down for a longer period of time, yes, you haven't had to deal with that recently, but you can't make investment decisions by looking in the rear view mirror. And unfortunately, that's what individuals do. What did well, if it did well, I have to expect that it will do well. So that's the place to put the money. Well, how have your bond holdings been over the last 5 years? Seriously, look at that. If you own bonds, let's have a conversation. Let's us show you exactly how bad those your quote-unquote safe money, your quote-unquote diversified strategy that is supposed to do well no matter what happens in the market, let us show you what those have done. Why are you still working with an advisor that utilizes risk management strategies from the 80s, the 90s? There are other options, i.e. the banknote strategy. Why play that interest rate game when we don't have to? But the point of the rabbit hole that I was going down, I never get to what I actually want to talk about because I go down these rabbit holes. But it's the way my brain thinks. I just always put myself on the other side of this microphone, and individuals driving around don't know me from Adam. And it's really all about, how can I educate you to allow you the confidence to keep doing what you're doing or question what you're doing and reach out so you can make sure that if the markets do drop, that you're protected. We're going to talk about tax strategies, and we're going to talk about concentration in the market, and we're going to talk about overvaluation after the break. So if you'd like to have an initial conversation or meeting with myself and my team, please reach out to Paige, 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. Happy Saturday. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. I am the host of this radio show, Destination Retirement. if you can hear my voice, we can absolutely work with you. We do run the show in multiple markets, although we are headquartered in Naperville, Illinois, just outside of Chicago. But we do, again, run this show in multiple markets. So if you can hear our voice, we do want to work with you. We continue to try to increase our footprint where we believe we can add the most value. So hopefully look forward to some announcements first quarter of next year. So if you would like to learn more about our portfolio stress testing software that we do complimentary for your current portfolio, it's probably one of the most sought after reports given what's going on in the market. We can actually take a look at your current portfolio and then stress test it against over 100 adverse historical market scenarios, not only on the downside, but also how well it will do in up markets as well. So that stress test is complimentary. It is very, very easy for us to run, but it'll give you an idea of if your advisor is actually adding value or if this is just the market. Markets go up, you make money. Markets go down, you lose money. And then it really just comes down to your advisor telling you to sit and wait. And when there are strategies out there like the bank notes that can give you double-digit returns, it may be 10, it may be 11, maybe 12, maybe 13%. Each note is different. With 30% downside protection, that means the markets can drop 30% up to 30%, and you're still getting paid your monthly coupon, whatever that annualized rate is. It is paid monthly. Those are strategies that you need to learn about. So 630-492-1912, 630-492-1912. Want to talk taxes and tax strategies, tax planning, tax reduction is, in our opinion, the most overlooked area of financial planning. If you're working with a big bank, if you're working with a big brokerage firm, if you're working with an independent, quote-unquote, independent financial advisory firm, yet they still have a broker-dealer, like I don't want to name names, but they're not a truly independent if they have a broker-dealer that they are working with, then you have very limited to what I would consider no proactive risk management strategies. One of the benefits of being independent, one of the benefits of not being part of a broker-dealer is that we have access to strategies that most don't, especially the big wirehouses or the big banks. They absolutely positively do not bring to their clients proactive risk management strategy, tax management strategies like our energy fund that last year, had you invested $100,000, you reduced your taxable income, active or passive, by almost $90,000. So $90,000 tax reduction, active, passive, W-2, 1099, capital gains, etc., per $100,000 invested. Talk about tax strategies. That is one. With targeted distributions, double-digit distributions, 10 to 20% annual. That is a very, very strong strategy. So if you sold a business, if you are a high wage earner, if you sold property, if you have stock options that you are exercising this year, if you are doing RMDs and you want to do those tax efficiently as possible, if you want to convert IRAs to Roth IRAs and do it as tax efficiently as possible, please reach out, 630-492-1912. Again, I'm not a tax advisor. I'm a financial advisor. These tax strategies, however, are very black and white, but it's always a best practice to speak with your tax professional before making any investment decisions that are going to have tax benefits. That's, again, just best practice. We suggest that all the time, but these tax strategies are very, very black and white. So I want to make sure that you know you've got almost 2 months left to reduce your taxable income this year for calendar year 2023. Think about that. All things being equal, you make $100,000, you make $1 million, whatever. Let's just use $100,000 for simple math. Last year, you invested $100,000 into the KCP Energy Fund. that provided an almost $90,000 tax benefit. So we're going to round up a little bit and use $90,000 for simple math. So before any other deductions, you made $100,000 last year of taxable income, and you put $100,000 in the energy fund. Your new taxable income, if you took that whole tax benefit in calendar year 2023, was $10,000. Think about that. Significant. Tax planning is a 12-month planning process. It's not end of year, but unfortunately everybody thinks about it end of year. So I challenge you, if you're working with an advisor, ask them, call them, ask them what strategies they have that can greatly reduce your taxable income. I'm not talking about tax loss harvesting, trying to match gains with losses. I'm talking about strategies that if you invested $100,000, it reduced your taxable income last year, active or passive, by almost $100,000. So those are the things that we're bringing to the table. Now, does it mean that you only invest based upon taxes? Absolutely not. Do you still have to read all of the offering memorandums and learn about the investment and see if it's appropriate for you? Absolutely, positively. So, but what we want to do is we want you to know that if you're a high wage earner, let's reduce your taxable income. If you are somebody that sold a business and you have, significant capital gains this year, let's reduce your income. If you sold a property with significant embedded gains, let's reduce your taxable income. If you have concentrated stock or stock options and you want to exercise, let's reduce your taxable income. If you have RMDs that you don't know what to do with, you don't really need, let's reduce that income that is generated by the RMD. If you have significant money in a Roth IRA and you want to convert it, or an IRA, and you want to convert it to a Roth IRA and limit the taxable income on that conversion, let's talk about reducing your taxable income. These are the things that good advisors do. They have access to strategies that you don't. They have access to strategies that 99%, at least is my belief, I don't know if that's right or wrong, but the bulk of advisors don't have access to. I know for a fact if you're working with a big bank or a big brokerage firm, they don't. So 630-492-1912, let's have that conversation. Stocks are concentrated. Concentrated risk, I think, it is at the highest level in more than 90 years. I guess that's probably fine. I don't know. But if you look at the market cap of the largest stock relative to the 75th percentile stock, we are at the highest level of concentration risk in more than 90 years. Yes, significantly higher than 2008, significantly higher than 2000. There's just a lot of concentration risk. Rob, does that mean that you think the market's going to crash? No. Here's what's going to happen. The market's going to go down. Market's going to go sideways. I ask people, people think, do you think the market's going to go down? Yes. Do you think the market's going to go up? Yes. Do you think the market's going to go sideways? Yes. Do you think the markets are going to crash? Yes. Do you think the markets are going to, go vertical? Yes. Nobody knows what's going to happen in the markets. It's all going to happen over time. The problem is, what and how much time do you have? I get so frustrated that advisors rely upon market averages. Market averages are over 100 years. 100 years worth of data. When you're 10 years from retirement or in retirement, I can make the case that it's absolutely meaningless to you. Because, again, we just go back to that strategy, or the Microsoft. If you bought Microsoft in 2000, which, yes, it was at the wrong time. Why? Because we saw the .com drop immediately. Look at what the markets were at that time. The valuations were incredibly high. Well, valuations are incredibly high now. Is this market like the .com market? I don't know. Again, what I think doesn't matter. Markets are going to do what the markets are going to do. There's some similarities, without a doubt. If you look at, 3 stocks make up 20 some odd % of the S&P 500, oh my goodness. You're going to live and die with those 3 stocks. So I don't like it when advisors talk about averages. I don't like it when advisors talk about when their portfolios are down because the market's correct, like they did in the early 2000s, like they did in 2008, 2018, 2022, and they reach out to their advisor and they say, "What do you think?" And the answer is, "Well, just sit and wait. You're going to be fine. Markets come back." Well, duh, nobody is saying that the markets don't come back. What I'm asking is, why didn't you, Mr. or Mrs. Advisor, protect me? Why didn't we have strategies in the portfolio that could either A, limit those losses, B, protect 100% against losses, or C, even make money if the markets are down to a certain point? Why didn't you have those strategies in place? Why are you telling me to now just sit and take it, sit and wait? Because you can do that on your own. You can absolutely do that on your own. And if that is how you want to manage your money, why are you working with an advisor? Go to Fidelity, go to Schwab, go to Vanguard, do a quarterly meeting, have somebody with generally limited experience, which is fine. I mean, it just is what it is. Craft what you would consider to be a diversified portfolio. It's not really diversified because you own equities and bonds, even though you may have 50 different investments, 20 different ETFs, or 50 different mutual funds or whatever. That's not diversification, at least in our world. Certainly not diversification in the institutional world. But if you want to ride the market up and down, don't work with an advisor. And it's my belief that 9 out of 10 advisors are simply giving you market performance with a fee. And that means you're going to underperform the market. I mean, if you're going to get market performance and you're paying a fee for that, you're going to underperform the market. And you are paying a very, very high premium to have your hand held when the markets go down. That shouldn't be what you want. I mean, it just should not be what you want, because there's tremendous amount of money to be made in the market. Tremendous. If you're invested correctly. It's just, don't do a closet index fund strategy. And unfortunately, 9 out of 10 people, that's what it is. Everybody think real estate is the best way to make money. We love real estate. Absolutely love real estate. I think you can make money in real estate. But if you bought a house for $500,000 15 years ago and sold it for $2.5 million today, so 15 years ago you paid $500,000 for a house, and you sold it for $2.5 million today, you would have still underperformed the S&P 500. Think about that. You still would have underperformed the S&P 500. I think people get amazed by real estate returns because it's one of the assets that they actually just buy and hold for the long term. So, again, just because you have risk management strategies in place, just because you have active management strategies in place, that does not mean we're against buy and hold, because yes, generally you're going to buy and hold. But what are you going to do when you buy and hold isn't the answer? Let's say 3 out of the 4 years it is the answer, and then the 4th year it's not the answer. But yet you work with an advisor that believes that that's the only strategy that works. Now, over 100 years, okay, fine. I mean, it's going to work. One of our equity managers on our growth bucket, I mean, if you put $100,000 in the S&P 500 in 95, the S&P is at $2 million. Phenomenal, right? But if you use a strategy that we use, that same $100,000, the value is actually at $3 million. Now, again, past performance isn't indicative of future results. That's not how you only make investment decisions. But nobody's saying that just because you believe in buy and hold, that you shouldn't have active management inside your portfolio, that you shouldn't have banknotes that can give you, double-digit returns with 30% downside protection. So really interesting statistic. I thought I'd like to share. I wanted to share that with you today. So you're listening to Destination Retirement. My name is Robert Kuhn. If you like what I say, how I say it, or how I educate on the radio show, then please reach out to Paige. Set up a time so we can learn a little bit more about your situation. 630-492-1912. 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners, independent. It's important. Fiduciary asset management firm that if you can hear my voice, because we do run in multiple markets, then trust that we can work with you. We are headquartered out of the Chicagoland area, so in just outside of Chicago in Naperville. But we do have a national client base. We love that. We continue to try to increase the footprint of the radio show. So if you can hear my voice, then know that it's worth reaching out if you like the education and our philosophy that we share on the radio. So 630-492-1912, 630-492-1912. Oh, goodness. So much going on. I guess there is an election coming up. We could talk politics and probably turn off half of get half of the listeners to turn down the radio. So we're going to stay out of politics. We look at, when we think about politics, we think about how it affects money. That's our job. Our job isn't to bring in our personal beliefs. Our job, no matter who's in office, is to construct and make sure that we are doing all we can to take advantage of whoever is in office. And generally, that is done by making sure that we have strategies in place that can do well in down markets, strategies in place that in up markets that have historically outperformed the broader benchmarks, and strategies that we would consider alternative that don't move directly based upon the stock and bond market, and strategies that can greatly reduce your taxable income. A couple of popular strategies that we talk a lot about on the radio and that a lot of people reach out to just simply because of these two strategies are the income bank notes. Those are the big bank notes that can be offered by J.P. Morgan, Citi, Bank of America, Goldman, etc. Generally, we can get double-digit coupons, so annual returns double-digit, as long as the markets don't drop 30%, whatever the indexes that note is following. So that obviously is very, very appealing given where the world is today. Most people are content with some money being invested in something that can still return double digits in a negative market. Tax strategies, obviously our tax strategy is incredibly unique. Certainly here in the Midwest, it's absolutely positively unique. It's unique, throughout the United States, but in the Midwest, it's 100% unique. I don't know of a single advisor that is bringing what we are to the table here in the Midwest. That tax strategy in the energy space last year reduced your active or passive taxable income by almost $90,000 per $100,000 invested. So if you invested $100,000 last year, you reduced your taxable income, active, passive, 1099, W-2, capital gains, etc., by almost $90,000. So that is a huge strategy. So either of those two pique an interest. If you want to learn more about financial planning, if you want to learn more about portfolio stress testing, we are doing a tremendous amount of those reports currently. They are complimentary. It's my belief I could charge $2,500 to $5,000 for those reports, and we probably would have 3 to 5 people a month that would want them. The data is off the charts, and it's very, very nice in this uncertainty of the market to take out advisors' sales pitch. Every advisor is going to give you a good sales pitch. It's just the way it is, right? I mean, this is just what we do for a living. And we can articulate stories, and we can articulate markets, and we can articulate, topics that most individuals don't have a good grasp on. Doesn't mean we're smarter. It just means, in my instance, we have a 25-year head start than you do. But unfortunately, it's just all a sales pitch. And when the rubber meets the road, which is when the markets are down, you're down with the market. And then when you reach out to the advisor, it's, well, buy and wait, sit and wait. You're going to be fine. It's going to come back. Well, that's not good enough, and it shouldn't be good enough for you. One of the great equalizers in financial advisory, or in the financial advisory space, is a portfolio stress test. It takes all of the sales pitch off the table, out of the equation. So you could see what you have today, what your portfolio is and how it is constructed, your current holdings, what it would do in 100 different adverse market scenarios, some way back when, some as recent as 2022, 2008, 2000, early 2000s. What happens if, the bonds continue to spike, even though the Fed's cutting? What does it do to your portfolio? I mean, it's off the charts. But here's what's even better. It's very easy to read. You don't need a PhD in, mathematics or reading to get the report, to understand the report. The biggest challenge is going to be this: you getting us your current holdings. That will be the biggest challenge, I promise you. Now, send the statements. That's the easiest thing to do. Upload the statements to our secure portal. That is the easiest thing to do. Now, some people don't want to send statements because it has an account number. Okay, fine, don't send statements. albeit there's nothing we can do with those statements, even if we have account numbers. Excel spreadsheet, what you have. I don't care. Just get me what you own. I need to know the amount, the positions of what you own, and we will run a complimentary portfolio stress test for you. And I think you will be blown away of what could happen, not only in the down markets, but also in the up markets. And then you'll be able to make a decision of whether it makes sense to continue to talk to us. And that's what we're doing a lot of right now. It is complimentary. Don't take the fact that it's complimentary as it's not what I believe to be the most cutting edge. We just absorb the cost that you're not going to pay generally. We absorb it for everybody, and it's more beneficial for us because we can, use that against hundreds of people rather than just you paying it. Most people won't pay the cost for it. So 630-492-1912, 630-492-1912 if you have any interest in that portfolio stress test. If you have 100,000, it's going to be a great report. If you have 10 million, it's going to be a great report. Somewhere in between, it's going to be a great report. It's all based upon you. We don't want you to think that you don't have enough money. We're a very unique group that we want to help everybody. And now, the strategies change, but we see far too many people saying you have to have this much money, you have to have $1 million, you have to have 500,000, you have to have 10 million. I think that's just more vanity for the advisor, truly. I think it's ridiculous. I think everybody needs help. We want to help you if you have under $1 million. We want to help you if you have over $10 million. And we want to help everybody in between. Why? Well, the S&P 500 has surged 40% in just 1 year. The S&P 500 has surged 40% in just 1 year. A couple things to think about. This has happened also before the 1929 and 2000 market crash. Is it going to happen again? Is history about to repeat itself? I have no idea. I mean, I couldn't tell you. Nobody could tell you. But it certainly could. And if we look at statistics, if we look at probabilities, if we look at, a term here recently is stock market melt up. That's something that you've started to hear a whole lot more about. Certainly popping up more in news. Some are getting excited while others are warning that this could lead to a disaster. So I don't know. I don't know what's going to happen. Nobody knows what's going to happen. But if I look at the S&P 500, it is clear that the market has been in a steep uptrend, delivering a 40% return since October 2023. I mean, a 40% return gain in the S&P 500. It's actually only happened 15 times since 1927. So just a 40% gain is very, very rare. And when you look at, what they've done in history, sometimes it is followed by a period of significant weakness. And that is what worries me, because history has shown not all melt-ups like we're in end badly. I mean, some are, have marked the start of a strong, long uptrend. And so I don't want you to hear that or hear me as saying that I think the market's going to crash. I think you need to have strategies inside of your portfolio that can still deliver positive returns in negative markets. That is something that I think is very, very important. But when you look at, up markets, when you look at high markets, generally when we're starting from a very high valuation, history tends to show us that some of the these moves, they just don't end well, and it just leads so much credibility, so much it's just common sense to get your portfolio stress tested. You want to know what could happen before it happens, and so that gives you a time. It gives you an opportunity to do two things: one, make changes. Certainly make changes, or two, know that if it does happen, what the consequences could be. And that's what we're trying to get the message out, especially in this type of a market, and especially in this type of a level that, the concentration risk in the equity markets is very, very high. And historically, the markets have delivered anywhere from 300% gains to 50% losses over a decade. That is crazy. That is a very, very wide return range. And when you look at periods of what, the melt ups that we experienced, before the 1929 crash and the melt up before the 2000, bull run, generally the markets have seen pretty significant declines over the following 10 years. And I think that's one of the reasons that Goldman Sachs, and again, they didn't call me and tell me this, but it was, it was publicly reported, that they believe that there's a high probability, I don't know how they worded it, but they expect the markets over the next 10 years to only average 3%. 3% a year. Think about that. 3% a year. So again, you know what they say about opinions, right? Opinions are like, everybody's got one. So it's nothing more worse than, financial advisors' opinion, because advisors are prideful people. And rather than, accepting that they were wrong and making changes, they're going to try to justify to you why they were right for being wrong. So we don't want to play that game. We just don't want to play that game. We want to play the game that, we've got a bucket of money and that bucket's different for everybody. It's 10% for some, 90% for others. I mean, everybody's different when it comes to that regard. But we have a bucket of money that can generate positive returns in negative markets. It's not me, it's predefined. You know the rules of the road going in. And it's a prospectus investment. It's an investment that is offered by the big banks, J.P. Morgan, Citi, Bank of America, Goldman Morgan, etc. And then we also have strategies that can remove 100% of the downside. Now, if you're removing 100% of the downside, there's certainly going to be a cap on the upside. That cap currently is in anywhere between the 9 to 10% range annually, and those are tied to the S&P 500. There's a ton of people out there that if we told you, listen, your worst year is 0, and worst year is 0. Market's down 1, your return 0. Market's down 100, your return 0. Yet you get the first 9 to 10% of the upside of the S&P 500. So yes, the market's up 20, you get 9 or 10 based upon whatever strategy you're in. So it's certainly not something we want 100% of the money in. But again, those are the things that we're bringing to the table. And if you don't have those, and you see that they could enhance what you're currently doing, then let's make sure we have a conversation. 630-492-1912, 630-492-1912. Give Paige a call, set that time up. Let's have our initial conversation, whether you come to the office or whether we do it over Zoom or whether we do it, just through a conference call. We're fine with that. So we're going to talk about the Magnificent Seven coming up in the last segment. So 630-492-1912.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We are independent. We are a fiduciary. We are headquartered in Naperville, just outside of Chicago, but we do run the show in multiple markets. So if you are catching me outside of the Chicago market, rest assured that we can work with you. If you would like to have your portfolio stress tested, it is complimentary. Before the election, give us a call. Before the end of the year, give us a call. If you'd like to know what your portfolio would do in good and bad times, we do stress test it against 100 different market scenarios. Again, it's not us. It's third-party software. It's one of the most technically advanced softwares that I have come across in my career. We'll do that, and we absorb that cost as a firm, so we will give that report out complimentary to you. If you don't like the results of those reports, then you're going to be more inclined to learn more about what we are doing. So 630-492-1912, 630-492-1912. So market concentration, we talked a lot about that this week. We've also talked about the Magnificent Seven stocks. over really probably for the bulk of this year. It's Apple, it's NVIDIA, it's Microsoft, it's Google, it's Amazon, it's Meta, which is formerly Facebook, and still Tesla. I mean, that's at least today how they're quantifying the Magnificent Seven. But if you look at the percentage of the S&P 500 of those 7 stocks, it is staggering. So are you really diversified if you own the S&P? Well, that's just something that we need to talk about. What happens if those 7 stocks don't continue to go vertical? X Tesla, which is now starting to turn around. What happens to the market? Does the market look differently? What if those actually go down? Does that dramatically enhance the downside? I mean, I think the answer to that could absolutely be yes. But when you look at the Magnificent Seven, they've added $2.1 trillion of market cap since August and are now worth $16.2 trillion. Think about that. $16.2 trillion, 7 stocks. The Magnificent Seven. You love it when it works for you. I promise you, if it goes the other way, the losses are going to be astronomical potentially. And so you have to really identify how much exposure do you have to those. You may not own the individual stock, but what if you own mutual funds? What if you own index funds? What is your exposure? So the group is actually trading about $800 billion below its all-time high. It did post that in July of this year, around the 10th. Year to date, the Magnificent Seven stocks have added a whopping $4.4 trillion. That is significant. I mean, just absolutely, positively significant. And we just have to look at, when you look at those 7 stocks alone, they currently account for almost 35% of the S&P 500. That's near the most on record. I mean, absolutely crazy. So the question is this like the late 90s? I don't know. The answer is yes, and the answer is no. Nobody knows. Unfortunately, the markets don't reach out to me, give me advance notice to say, hey, Rob, make sure that your clients are protected because we're going to ring the bell. And these 7 stocks that have possibly disproportionately run the market up are now going to sell off significantly. And people are going to lose a great amount of money. It would be nice if it did, but it doesn't. So our answer to that, since we don't get a notice pre-market sell-off, is to craft portfolios that can still deliver positive returns in negative markets for some of the money. If you have an interest in the banknotes, if you're happy with double-digit returns generally, backed by one of the largest banks in the world, that has 30% downside protection. So as long as the indexes that note is tracking are not down 30%, you're still going to get your monthly coupon payment. All they do is whatever the note is paying for the year, they divide that up in monthly payments. So if it's 12%, you're going to get 1% a month. If that makes sense to you, well, guess what? You don't necessarily need to worry about all of the what ifs, because we certainly have to plan for the what ifs. But these strategies, they used to require, depending on the firm you work with, the one I worked with, and actually required $1 million net worth. And there was minimum investment thresholds, which were generally unattainable from most individuals. Today, the minimum investment is $1,000. $1,000. Problem is, most advisors aren't doing them. Why? Well, because they didn't do them while they were building their business, and they're not going to incorporate new strategies. And one of the most common observations after someone reaches out to us via the radio or comes through to us through one of our dinners that we host is, why doesn't everybody do this? And that's a great question. Why doesn't everybody do this? Why doesn't everybody put some money in a portfolio that can get double-digit returns with 30% downside protection? So yes, the markets could drop 29.99, and on that monthly valuation, as long as they're not down 30% from whatever the indexes are tracking, you get paid your payment. People like that. And so now's the time for us to get very loud, get very vocal, because we've got a lot coming up. We've got a lot of issues. Inflation, good luck to you. They say it's at 3%. My bank account says it's certainly significantly higher than 3%. Fed cut rates. Look at what happened to the long bond. I mean, you probably heard a ton of real estate agents, mortgage brokers, et cetera, get out when they did cut rates saying, hey, good luck, market rates are coming down. Well, they did the exact opposite, at least as of today. They've spiked pretty significantly. And so when that happens, generally you have, there are, advisors or money managers. Some would consider two of the top in history that have been very public and very vocal that are betting against the interest rate market. So they will actually make money when rates go up. Personally, in their funds, they will make money when the market's interest rates go up. But yet the Fed is cutting rates. They're supposed to go down. What gives? Well, if rates do spike and the Fed can't control it, guess what? Watch out with the equity markets. You could see losses that so quickly that you've never seen before. Are we calling for that? No, we're not calling for that. I mean, that's certainly not our base case. But again, what my base case is totally irrelevant. Our job is to make sure that we have strategies in the portfolio that can protect if and when that does happen. We don't want you to call us and say, we missed it and don't worry about it. Markets, average X over, 10 over, markets average 10% on average. Well, that's 100 years worth of data, right? So that probably really doesn't mean a whole lot if you're 10 years from retirement. Well, really, it doesn't mean anything to anybody listening. I mean, nobody listening driving a car has a 100-year time frame. So if that's your advisor's answer is time in the market and not having proactive risk management strategies, then you owe it to yourself to make a change. If you want to reduce your taxable income significantly, to the tune of $90,000 per $100,000 invested, and you want to learn about strategies in the energy space that have targeted double-digit distributions in addition to the tax benefits, let's have that conversation. Those are things that we're bringing to the table. If you want to stress test your portfolio, there's only one strong, not average, strong portfolio stress testing software that I have seen. I'm talking the best of the best, not just a basic, you can go and get free stress tests online. I mean, those are so basic. I certainly wouldn't pay any money for it. But we have access to the best stress testing software. I am convinced I could sell that for $2,500 to $5,000 a portfolio. Most people would pay that to know through 100 different scenarios in the market and history what your portfolio would do, whether it's up or down, and what those returns would be either up or down. But we're giving it away complimentary, and it just takes a call, takes us you to get us what you own, and then we'll do that for you complimentary. And if you don't like the results, then you'll probably want to have a conversation about what we're doing. If the results are good, well, then guess what? We just reconfirmed what you're doing is the right thing. So there's really no downside. So with that being said, I want to thank everybody for listening. Crazy times ahead. Crazy times does not mean that the market's going to crash, but it certainly means it could. So you have to prepare for both. If you'd like to have a conversation with us, reach out to Paige. She will set that up for you. We'd love to welcome you into our office. If you're not local or you're not ready to come into the office, we can certainly meet over Zoom. Or if you don't want to meet over Zoom, we could have a conference call. It's really whatever your agenda is. We're here to try and help you. So 630-492-1912, 630-492-1912. Have a great week, and we'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.